Welcome back. This morning, the Producer Price Index PPI was released, indicating a decline month over month of 0.1%, in line with expectations. Wholesale prices increased 8.7% on a year-over-year basis. That was below expectations of 9.8%, actually the lowest level we've seen in quite a while. Looking to the PPI on the chart, bottom left-hand side, we can see after a long trend to the upside, we now see 2 consecutive months of lackluster reports. Now, yesterday, obviously, the stock market was very weak in reaction to a very hot CPI, Consumer Price Index. It's important to recognize that the PPI, Producer Price Index, the number we saw this morning, is considered a leading indicator. It reflects the cost of goods and services at the producer level. And it's thought that the producer will eventually pass on those higher or lower costs to the consumer, reflected in the CPI, which is the number we saw yesterday. So the question is, can we put more stock into the CPI yesterday, leading us to believe the Federal Reserve will continue to raise interest rates very aggressively, and in turn that may weigh heavily on the stock market? Or is the PPI the beginning of a trend, a change in trend? Now, of course, one or two reports does not make a trend, but we should take a look at and consider leading indicators, as they tend to move before some of the other ones do. Taking a look at the CPI, we can see over here yesterday's number was a positive, or an increase, not necessarily positive, an increase. Compared to the CPI, we have two negative reports over here. Again, the Federal Reserve is very aggressive and has pledged to be very aggressive to raise interest rates to combat inflation. But the question that everyone is asking themselves is, does today's PPI number indicate that maybe the CPI will begin to weaken? And if that's the case, maybe the Federal Reserve can take their foot off the gas pedal to some extent. Here's on a year-over-year basis. We can see this month's PPI compared to August of last year, is the lowest report we've seen in quite a while. Actually, August of last year. So, again, the Federal Reserve is watching many different numbers, not only inflation. They're also looking at manufacturing numbers and confidence numbers that we're going to see later on this week. We can see over here the PPI was released. It's starting to pull back. It's certainly not the lowest level on a month-over-month basis that we've seen, but it certainly is, or at least looks like, a little bit of a weakening in the overall trend to the upside. Taking a look at the financial markets overall, the gray bars indicate the 30-day change, and the largest change to the upside on any of the financial markets that we follow over here is the NASDAQ Volatility Index and the VIX, which is the volatility index based on the S&P 500. So over on a 30-day or on a monthly basis, we should say, these seem to be the best performing markets. Now, conversely, you look at some of the weakest markets, that may include some of the cryptocurrencies like Bitcoin. Certainly commodities like gasoline have been very weak, which has contributed to the weakening PPI number. Now, if we exclude food and fuel and we look at the core PPI, that obviously was a little bit hotter than the weak PPI, taking into consideration fuel. So if we start to see prices go up at the gas pump, we may be led to believe that we're going to see inflation really kick off and continue higher. Now, based on yesterday's very weak stock market, this certainly has transferred over to the FX market. We can see the US dollar over here as an RSI 56.79. It's in a general trend to the upside, no surprise, as the dollar tends to move in the same direction as the expectation of interest rates, in this case of the upside. But more interestingly, notice today's biggest move to the upside, and this is just a reflection of the change in the relative strength, is the Japanese yen. The Japanese yen is a very low yielding currency. It tends to receive capital. FX traders tend to buy the Japanese yen When stock markets go down and they're looking to preserve their capital, if things look more optimistic, then obviously traders are going to look to higher yielding currencies like the Australian or the New Zealand dollar. Now, finally, I think this is a very interesting look at at the state of our economy. The left-hand side of the chart is the 10-year Treasury bond versus mortgage rates. And what this is considered together is the mortgage spread. And this is an economic number that, that a lot of analysts will really look at very closely. Again, the red line represents mortgage rates, loosely tracking the 30-year bond, but it's actually an average of the mortgage rates. And traders and analysts will tend to look at the spread between mortgage rates and the 10-year Treasury bond. Moving to the right side of the chart, though, that yellow line represents the spread. The yellow line actually indicates the difference between the two lines on the left-hand side charts. So the mortgage spread, the difference between the mortgage rates on a 30-year basis, or the average 30-year mortgage, I should say, versus the 10-year Treasury bond, that's reflected in the yellow line. The purple line is the S&P 500. And notice you have a pretty strong correlation, meaning that when the stock market goes down, we tend to see the mortgage spread compress. When the stock market goes up, we tend to see the mortgage spread widen. Now, this, of course, also takes place, we spent quite a bit of time talking about the inversion in the bond market, and that when stocks go up and there's generally an optimistic tone within the economy, traders will tend to buy the short-term bonds, and that will lead longer-term bond yields to move even higher and move further away. Conversely, when the stock market goes down and and there's more of a pessimistic tone within the economy, traders will sell the short-term bonds. They said, "Oh, short-term, I don't have a lot of confidence. Long-term, I like our prospects better." So short-term bond yields will go up, and that's really what we've seen as of late. So we're going to continue to watch this. The mortgage spread, it's not only a reflection of the 30 and the 30-year bond and the 10-year bond. It's actually the reflection of mortgage rates to the 10-year bond. And so this also not only takes into consideration what's happening in the bond market, but also the optimism within the housing market. It's actually one of the key components that a lot of analysts will use to watch, to try to predict what the housing market will do in the future. So we're going to watch this, and we're going to be talking about a lot of other indicators moving forward, specifically targeting the housing market. But I thought it was quite interesting to see where we are right now. And the purple line we can see as of yesterday, big jump to the downside, reflecting our 1,300 point move in the Dow. Certainly the S&P 500 is very weak as well. And the mortgage rates did compress. If we expect to see stocks move lower, I would also probably tend to assume the spread would move in the same direction as well, to the downside. We hope this has been helpful. We look forward to seeing you back soon.